Hey dividend investors, today I'm going to talk to you about PE ratio. What is a PE ratio and how you can use it to make yourself a lot of money. Basically, what a PE ratio is the price of the stock versus the earnings of the stock, and basically the multiple that it trades on. Now, if this is still confusing, basically, if the stock stays at the same price, but they start making more money, the PE ratio will go lower. Meanwhile, if the stock stays the same price, but the earnings go down, the PE ratio will go up. The other side of things is if the stock price goes up and the earnings stay the same, then the PE ratio goes up. Or if the stock price goes down and the earnings stay the same or go up, that means that the PE ratio will go down. And you generally want, if you're going to buy a stock, let's say the Canadian banks as an example, what you can do is to look at all of the Canadian banks and say, well, let's look at which bank is the cheapest. And if you ever hear, let's say, CNBC or BNN or whatever saying this stock is cheap right now, they are generally talking about PE ratio. So as an example, we have a PE ratio on the Bank of Nova Scotia of 14.84. Meanwhile, the PE ratio of National Bank is 13.8, which technically means that National Bank is actually a cheaper stock than the Bank of Nova Scotia. However, that is only in theory because, of course, we have to also look at future earnings potential, which bank is going to be making more money. Also, the future stock price itself. Where is that chart really going? Will it be cheap in the future, or can we make a quick day trade? And one way that you can actually look at a stock and say if it's actually cheap in the future is, of course, you can look at that PE ratio. That is one option. However, what you want to also look at is the volume concerning the price of the stock. So as we can see here, National Bank on the exact same day was down 3 cents, while the Bank of Nova Scotia was up 38 cents. The PE ratio, however, is cheaper for National Bank and more expensive for the Bank of Nova Scotia. So why would there be more money flowing into the Bank of Nova Scotia versus the Bank of Canada, the National Bank of Canada? Well, actually, we can look at the volume now. The volume of Bank of Nova Scotia was 13.9 million shares traded that day, with an average trade volume of 4.3 million shares. Meanwhile, the National Bank of Canada had 1.5 million shares traded that day, with an average volume of 1.6 million. This right here is the reason why this stock went up. There was a ton of people buying, especially at the close, and we can see that with the actual chart that I just so magically have here of course, the Bank of Nova Scotia, because I'm doing another video about the banks, or at least recording them today. And as we can see, there was actually a high amount of volume at the close, which was why the stock rose. There was a lot more people buying than there was selling. So are people buying the Bank of Nova Scotia because it's cheap? Probably not. They are actually expecting probably the Bank of Nova Scotia to have higher earnings in the future, and the Bank of Canada, the National Bank of Canada, to not have as many high growth earnings in the future. And we can tell that by actually looking at the forward dividend as well. The forward dividend for the Bank of Nova Scotia is 4.5%, while the National Bank of Canada is 3.3%. And to me, that's actually a good indicator as to where these stocks might be at in a few years. Usually banks with a higher dividend are the ones, at least here in Canada, that were not favored recently versus the banks that were favored recently. And we can see that by the National Bank of Canada's actual chart, which I don't have for this video. However, we can actually see in their chart that they have actually rose quite a bit recently over the last few years, while the Bank of Nova Scotia has been stagnated. You usually want to look at the banks that have stagnated in Canada for future growth, especially when their dividend is much higher, because that's a good indicator that there's going to be better times coming ahead for the stock. However, you cannot deny the fact that the National Bank of Canada is much cheaper than the Bank of Nova Scotia, and really, in my own personal opinion, you really cannot go wrong investing in any of the Canadian banks. You generally, at least in my theory and how I like to trade the banks, is by looking for the highest dividend and the cheapest PE ratio together. Whoever has the cheapest PE ratio, there's 6 banks in Canada, the bottom 3 who have the cheapest 3 banks, whoever has the highest dividend out of those 3 are the ones that I usually buy the most. And then, of course, I reevaluate this every 2 to 3 months, and I say, okay, I'm going to target this bank and whatever other kind of banks. Right now, I'm kind of personally chasing BMO, and that's just a personal decision of mine, because not for how the actual stats line up when it comes to the PE ratio, the dividend, and all that. It was because they blew out earnings in the States on their American side of earnings versus somebody like TD, who actually has a larger American footprint than BMO, yet BMO's the one who blew out TD. So that is the reason why I'm investing more into BMO right now, but you can't deny PE ratio is a great way to be able to see which stocks are the best. I hope that you've enjoyed today's video. If you have, hit that like button and subscribe. You can use this strategy with anything. You can look at Microsoft and Apple, look at the PE ratio. The cheaper PE ratio is generally the one who's going to go higher in the future, or at least in the short term. I hope that you've enjoyed. If you have, hit that like button, subscribe, and I'll see you guys again next time.